Let me ask you something. Why do intelligent people, people who work hard, save money, and genuinely want to invest well, still end up with making terrible decisions with their portfolios? And why do investors around 50 to 55 often panic near the exact moment the markets begin a multi-year bull run? It's not because of lack of information. Today, we have more financial information than any other time in history. Market forecasts, economic data, investment research, thousands of options every single day. And yet, most investors still make the same decisions. They buy when prices are high and panic when prices fall, which means the real problem isn't information, it's behavior. For years, I believed investing success came from finding the right opportunity, the right stock, the right market movement, the right predictions. But eventually, I realized something rather uncomfortable. The problem wasn't the market. The problem was how I was reacting to the market. My decisions were emotional. When markets were rising, I felt confident. When markets were falling, I felt uncertain. And when the news cycle sounded alarming, I froze. I didn't do anything, which meant my portfolio wasn't being guided by a strategy. In this video, I will discuss my 3-bucket system strategy because I don't want my emotions to be guided by my mood. And that's when I realized something had to change, my system. Professional investors rarely make decisions the way individuals do. They don't wake up and ask, what should I invest in today? Or what do I feel like buying today? They operate inside a framework: asset allocation, risk management, and capital preservation. These are the words professionals use because they understand something most investors learn the hard way. The biggest threat to a portfolio is not volatility, it's emotional decision making. A long time in my 40s, I followed markets obsessively, checking prices during the day, reading financial headlines, watching commentary. I even joined a Discord group of like-minded risky investors at the time. Every piece of information felt important. But that constant input created 2 destructive emotions: fear when the markets declined and overconfidence when the markets rose. Both led to mistakes. Eventually, I realized something very simple. If I wanted long-term financial stability, I needed to stop reacting to markets and start structuring my money. Instead of building a portfolio based on predictions, I built a system based on roles. Every dollar in my financial life now has a job. And that system became what I call the 3-bucket system. The first bucket is what I call the foundation. This bucket has very simple purpose: stability. This includes my emergency reserves and my defensive assets. Money that is designed to protect my financial life if something unexpected happens: job loss, medical issues, economic downturns. In finance, we call this capital preservation. You see, this bucket isn't trying to beat the market. It's trying to grow aggressively. Its job is psychological as much as financial. Because when markets become volatile, and they always do, this foundation prevents small problems from becoming large ones. It allows the rest of my portfolio to remain invested without panic. One of the most underestimated forces in financing is sleep quality, and I know this very well. When your financial foundation is strong, you stop worrying about every market movement. You stop reacting to headlines. You gain something more valuable than returns. You gain stability. And stability allows the rest of the strategy to work. Now, let me explain my second bucket. I call this bucket the engine. Its job is growth, not speculation, not short-term trading. Growth through broad market exposure. Instead of concentrating risk into a few individual investments, this bucket focuses on diversification across global markets, thousands of companies, multiple sectors, multiple economies. In finance, this is known as systematic exposure to global equities. The goal here is not to predict what company will outperform next year. The goal is to participate in the long-term growth of the global economy. You see, over time, businesses expand, innovation happens, productivity increases, and diversified equity markets tend to reflect that growth. This bucket is designed for a long time horizon, years, in my case, 14 or 15 years, sometimes, in other cases, decades. That's because time horizon does not react to short-term volatility. Daily market movements become background noise. The engine simply keeps running, slowly compounding, year after year after year. Now, let me explain my third bucket. Is the one that many investors misunderstand, and in fact, it's actually my favorite bucket. I call this the opportunity reserve. In practical terms, this means keeping a portion of capital in high liquid, low-risk instruments, cash equivalents, short-term government debt, assets designed to preserve purchasing power while remaining accessible. Many people hear the word cash and assume it means someone is trying to time the market, but that's not the purpose here. This reserve exists for flexibility. Markets move in cycles. There are periods of optimism and there are periods of fear. When markets decline sharply, investors who are fully invested often feel trapped. They watch prices fall and have no capital available to act. But when you maintain an opportunity reserve, market volatility changes character. Declines stop looking like threats. They begin to look like entry points. Institutional investors operate this way constantly. They maintain liquidity, not because they can predict downturns, but because they know downturns eventually occur. And in fact, they do every year, multiple times. And when they do, liquidity becomes a strategic freedom. There is one more rule that shapes this entire system, and it's nothing to do with markets. It has to do with expectations. You see, when I estimate future portfolio growth, I don't assume the highest historical returns. I assume more conservative outcomes. This way, I don't get disappointed because optimistic financial planning has a hidden weakness. It only works if everything goes perfectly. Markets cooperate, inflation remains stable, economic growth stays strong. But conservative planning assumes something different. It assumes reality, cycles, volatility, uncertainty. And when your plan works, even under conservative assumptions, something interesting happens. You stop worrying about the future because your system is designed to survive it. You see, the purpose of my three-bucket system is not complexity. It's clarity. Instead of looking at one large pool of money and wondering what to do with it, each bucket has a defined role. The foundation protects stability. The engine drives long-term growth. The opportunity reserves provides flexibility during market volatility. Together, they create something that many investors struggle to achieve. Not just returns, but calm. Because the most successful long-term investors are not the ones who predict markets perfectly. They're the ones who build systems that continue working, even when markets become unpredictable. And that's exactly what this system is designed to do. Because optimistic planning requires luck, but conservative planning succeeds without it. In future videos, I'll break down each part of the system and show you exactly how it works. I'll see you in the next video.